Okay, good evening, everyone. Welcome to another Sequoia Enterprise Solution Wednesday night call. Um, so today, I think it's a good time for us to answer some of the questions that many of our agent is asking for. So once in a while, we will do this FAQ session. Hopefully, these questions are pretty much. I would say most of agents that when they come to Sequoia, sooner or later they will ask similar questions. So I think it's a good idea for us to dive into it and share with you what other people's asking and how to answer some of these questions. Okay. So without further ado, let's move forward. We are going to break uh, the questions into three different categories. The first one, it's the commercial real estate. The second one, commercial real estate is anything to do with uh, commercial real estate, like warehouses, retail, shopping centers, office, apartment, things like this. There's no residential component to it. Okay, so that is the first category. The second set of questions that we will ask is we get related to working capital, equipment loans, SBA loans, things like this. And then the last set of questions is something to do with DSCR loans or residential 1 to 4 unit mixed use apartments, multifamilies, so on and so forth. Okay, so let's dive into it. What is the interest rate? I bet every one of you is going to ask these questions or already have asked these questions. So when you come into lendings, what is the interest rate? So in the commercial lending world, unlike the residential, see, when you go to a traditional loan company and ask, hey, what is the interest rate? They can pretty much tell you, oh, today's rate it's 6.5, 6 and a quarter, whatever that might be. It's because on their side, everything is cookie cutter. You can actually check the rate online. You don't even have to ask them. But coming to commercial lending is different. Keep in mind, first of all, as a broker, we do not have any interest rate. The interest rate does not come from us. Okay. The interest rate is coming from all of our lenders. So, how do they determine an interest rate in commercial lending? A few things. Number one, we need to know how much money are you looking for. If you're talking about $100,000 loan versus a $10 million loan, is totally different. So as you can see on our platform, we do many different type of commercial lending. Fix and flips is commercial lending. Multifamily commercial lending, apartments, office, retails, constructions, hotels, all these different type of asset or different type of loans, they are all commercial lending, and each one of them are different. They're not the same. Okay. So when people ask you what is interest rate, or when you ask what is the interest rate, normally there are a few questions that we need to ask, right? Number one, how much money you're talking about? Now they're not in any particular order. Okay, so the first question that you need to ask is how much you're looking for. 100,000, 200,000, 5 million, 10 million. So that's the first thing. The second question that I always ask is, so what do you need the funding for? Meaning that tell me about your project. Okay, are you doing a construction? Are you doing a land development? Are you doing a multifamily? What is it? Now, let's say it's multifamily. Let's say it's an office. We are talking about commercial property right here. So let's say an office, right? Is that office fully occupied? Is the office DSCR? Is that office vacant? Or is that office you need funding for renovation? So now different status, different conditions come up with different interest rate. So, what do you need the funding for is also very, very important when we try to answer that question, what is the interest rate? And of course, the next thing that we need to ask for is that how soon do you need the money? Quite frankly, a lot of the people come to us asking for funding and say, hey, I need the money yesterday. Then now the question is that why do you need the funding yesterday? And now you're asking me for a loan today. There got to be a story behind it, meaning that got to be something happen along the way. In a normal situation, a client would not come to any lending sources asking for a fund the day before He needs the funding. Obviously, he has been looking for funding for a long time, and they got turned down many, many, many times. So we need to find out what is the story behind it, right? Is that there's a lien on it? Is that is it because the project is doesn't make sense, or is it because the principal doesn't make sense, or is it because they do not have any liquidity, does not have any money, or whatever that might be? There got to be a reason that the client is looking for funding yesterday, right? They need the funding yesterday. Okay, so how soon do you need the money? And if somebody's saying that, oh, I'm not in any hurry, right? My loan, I have 6 months, I have 3 months, or some people saying that, hey, I have a bridge loan with my property and it's not going to expire until the end of the year. Right now, I'm start looking. Okay, fine, right? So now I understand what the urgency is. So we need to know how soon do you need the money. And of course, the last thing is that how long do you need the money for? People saying that, hey, I might need this thing for just 3 months. Then I know it's a bridge loan. Or somebody saying that, hey, this property is already stabilized. I want to have a long-term note. Okay, so this is going to be a DSCR loans, right? So now a bridge loan, the interest rate on a bridge loan versus an interest rate on the DSCR loan is totally different. So again, those are the questions that we ask our clients to determine what that interest rate is. So boil down to the bottom, on the commercial lending world, the interest rate determined by what? By the project. If we have interest rate anywhere ranging from 5% all the way up to 30%. It depending on what do you need the funding for, what that project looks like, what is the experience level for the client, so on and so forth. So that is how we answer that question. So when somebody asks you, when your client asks you, what is your interest rate? What do we need to do? What we need to do is that we need to start to listen, start asking questions. Okay, tell me about your project. Tell me about what you want to do. Who's running the project? Who's building this? What is the pro forma? If you're selling it, what is the ARV value? So on and so forth. So that is why we call ourselves the loan what consultant. What does consultant means? I listen. I help you to solve your problem. Okay. So what is the interest rate based on one word? Risk. The higher the risk, the higher the interest rate. The lower the risk, the lower the interest rate. Okay. Now, and another thing, if you really wants to see what that interest rate is, my suggestion for everybody to do is to pay attention to the stock market. Pay attention to the oil price, the crude oil price. Anybody know what the crude oil price is today? $85.
$80.
80 some dollars. I think it's $80 a barrel. Anybody know what is the crude oil price at the beginning of March? March 1st, 2026?
$50.
$60. Okay, you can do a Google search. So you can see for the last 2 weeks, the crude oil jumped from 60 to 80, 85 bucks. So guess what? The interest rate it has gone up, right? And also pay attention to 10-year treasury, right? There are many indexes that we can follow, but normally if you want to see if the interest rate up and down, normally I look at 10-year treasury. So anybody know what the 10-year treasury is at the beginning of March? I think it's 3.64. What is it today? 4.3. So in 2 weeks, it jumped almost 1 point. So again, now it can give you an indication what that interest rate looks like. Okay, so that is the first question. What is the interest rate? Now, also a lot of people ask, hey, why your rate is too high? First of all, it's not my rate. I don't have an interest rate. And I already mentioned interest rate is based on what? It's based on the project. The higher the risk, the higher the interest rate. The lower the risk, the lower the interest rate. But however, there are many ways to get a project done. So the first thing I normally ask our client is that, hey, what is more important to you? Are you rate sensitive, meaning that you are looking for a low rate, or do you want to get the funding that you need, or are you time sensitive? What is the difference? Rate sensitive means that, hey, they are out there shopping around. They don't have any urgency. They can, shop around with local bank. They can shop around with local lenders or whatever that might be. Their goal is to look for the lowest rate. Time sensitive means what? Hey, I don't care about the interest rate. I care about time. I need to get the money as soon as possible. So when somebody's saying that, hey, Alan, why your rate is high, is because most of our clients that come to our shop, they are not bankable, or they don't want to deal with the bank. Now, I often say this: if a client can go to the bank and get a loan, they don't need to come to us. And we strongly suggest them to go to the bank first because the bank has the lowest rate, they have the lowest fee if they're willing to deal with the bank. But however, what is the other side of the coin with the bank? It takes a long time. They look at a lot of documentations, and most likely they will fund very low LTV or LTC, whatever that might be. Okay. So our rate is high compared to what? Most people compare to the bank rate. Yes, indeed, our our lenders rate, most of our lenders rate are higher than the bank. It's because we are alternative fundings. There's a lot of things that the bank look at, our lender do not look at. Hence, what? Higher the risk for the lender. Hence, what? Higher the rate. But because we are commercial lending, many of our clients, when they come to us, they already been through the bank. They cannot get their loan done. Their project needs funding. So no matter how low the interest rate is with the bank, if you cannot get it done, it doesn't make any sense. It's not doing you any good. Coming to us, the chance for you to get the funding is much, much higher. So many, if this is a seasoned investor or an experienced investor, they will put the rate as part of the what? Operating costs. For example, if you want to build a house, not only the what? Not only the interest rate is high, but a lot of the materials are high. The cost of the materials increased. The cost of labor also increased. But why they still have to do it is because that is part of the operation. So as a consultant, don't be afraid to go out there to let people know that, hey, this is our product. Our goal is to provide you a solution to your project. And oftentimes we see a lot of clients that come to us. Many, many times, literally, I have a client that came back to me 2 years ago. I gave him a term sheet and he's saying that your rate is very high. And 2 years later, he's still coming back to us. That is just human nature. Okay. Next question. It's what is the down payment? Now we're talking about commercial property. Please do not compare this to buying primary residence. Buying a primary residence, you can do FHA loan, you can do VA loans, we can do primary loans, and you can put down as little as 3%. VA loan, you don't even have to put down anything if you're veterans. Please do not compare with that. This is a commercial properties. So minimum anybody would, any lender would like you to see it's 30% for pure commercial property. I'm not talking about apartment. We are going to talk about that later. I'm talking about retails, shopping centers, office buildings. We are talking about uh, um, uh, parking lots, hotels, things like this. Okay. So down payment minimum, it's 30%. Now, if you're talking about a bridge loan, normally they even require you to put down 40%. Okay. So it really depending on the type of asset. Now, of course, it's different type of assets have different type of down payments. And also depending on the DSCR, meaning that, hey, let's say if I purchase a, a retail, okay, and they're all rented out. Let's say, rented out. Okay. So I will look at, as a lender, I will look at how long is that lease. If that lease has 10 years, very good. To me, it's what? Less risk. Then I can allow you to put down less down payment. But if that lease is going to expire next year, to me is what? High risk. So in that case, I might require you to put down more down payment. So again, it back to the word risk. The higher the risk, the lender would like to have less exposure, have less commitment to the deal. Okay, so that is what the down payment is. So prepare minimum 30% down on commercial properties. Next question, oftentimes we have client come to us saying, "Oh, Alan, my client is buying this property and so on and so forth. Their income is this. Okay, fine, stop right there. I don't care about their personal income. When you come into commercial lending, I don't care about their personal income. What the lender will care about is the income from that particular property. Now, of course, you have personal income, you have a high personal income, that's good, that is a plus, but that is not a must. Okay. So most of our, well, most, I would say 99% of the time when they purchase commercial property, we do not look at their personal income. The only time we look at their personal income is when they are purchasing a commercial property for their own personal use. For example, I am a doctor. I have been practicing, have an office. I've been leasing that office. But now I want to purchase this office condo. I want to purchase this building for my own practice. So in that case, we do need to see their personal income and their business income. So that is the only time that we look at personal income for commercial properties. Okay, let's move on. What are the costs associated with doing a commercial loan? Um, Pretty standard. We do have to do an appraisal. So we do not determine how much that appraisal cost. So in general, the lender will order appraisal through a platform, through an ACM platform, just like an Uber, right? So when you call an Uber, you when you call a taxi, right? You use an Uber, you you tell them where you want to go, and then all of a sudden somebody pick up that order. So same thing with the ACM platform. So the lender is going to order an appraisal through the ACM platform, and they have no idea who will pick that up. So the first cost is appraisal. There will be insurance costs. The lender will require you to purchase insurance after doing the evaluation of the project. You have the title costs. You have the processing. The lender will process your file, underwriting costs. And of course, most importantly, is the consulting fee that we charge. And some lender also charge their fees also. Let's say, for example, we are talking about a bridge loan. The bridge loan lender will charge a fee also. We charge a point. So again, those are approximately what all the fees and costs are associated with this particular for commercial loans. Now, in some cases, there will be upfront costs. For example, you are talking about $20 million construction loan. Okay. Or you are talking about a $10 million office renovation project. So a lot of these big projects require the lender to do a lot of due diligence. They want to check on the client's background. They want to make sure that there's no criminal record whatsoever. So they have to order third-party reports. They have to do evaluation on the project. They have to do surveys, so on and so forth, and they have to start processing the loan. So no lender is willing to start working without some sort of commitment. So many times lender will ask for an upfront fee if that loan is big enough in the millions. Okay. Normally they're asking for a few $1,000 up to 10, 20, $30,000. It's pretty reasonable. Okay, so prepare for that. So those are the different type of costs associated to get a loan done. So in today's market, as everybody know, the capital is not cheap, right? The interest rate, the prime rate is still at 6.75. So if you are looking for investors, the investors is going to come in and take a percentage of your project, your profit. So there's no cheap money out there right now. Okay, but that's the cost of doing business. Next thing, How fast can you close the deal? Now we are talking about commercial, okay? If just a regular office condo, for example, ranging from, anything from a few $100,000 to $1 million. So this type of loan is pretty simple, pretty straightforward. Um, of course, it depending on how fast the client will willing to work with us. Oftentimes, remember, we are dealing with business owners. They are very busy. The most important part, the most difficult part to get a loan done is to get the documentations we needed to get the loan to go to closing. So if the client is not providing the documentation to us, pretty much there's nothing we can do about it. So we all we can do just to pound on it, and just keep pushing forward. So assuming the client is very cooperate, cooperative, and sending us every time when we ask for documentation, they will send it to us. So normally for such loan, we are talking about anywhere between 30 to 45 days, we can get it done. Okay. Now moving on to some bigger projects, apartments, retails, hotels, those will take much longer. It's just because there's a lot of variables associated with underwriting that loan. Okay. And oftentimes with big projects like this, believe me, we will always find something that the client does not know. Perhaps they have a mechanic's lien. Perhaps they have a loan that they already pay off, but they somehow, somewhat, they forgot to record it with the county. So the lien is still on the property. There are so many reasons for a loan to get delayed. So how fast can we get it closed from our perspective as a broker? This is our job, right? So once we receive the documentation, we will process it immediately. Same as the lender, same thing as any third party report. So that's another thing, third party report. We need to order an appraisal. Okay. If the property is in a metropolitan area, we might be able to find an appraisal pretty quickly, and they can go out to do the loan pretty quick, to do the appraisal report pretty quickly. But however, if the property is in a rural area, it might take some time for the lender to identify uh, an appraiser. And in some cases, I mean, we just closed a land deal in Houston. It took for a whole week. There's nobody taking up that order in that area. So we end up have to ask the client to refer some appraiser to us, to use those appraisers to go out there. So again, all those are the unknown variables that we have to deal with on a regular basis to get the loan done. Okay. So count on us. We do whatever it takes to push this thing as fast as we can. But of course, we also need the client's help also.
Yeah, Alan, if I could inject
Right.
just real quick,
Next question. Oh, sure,
Alan.
sure, George, go ahead.
Yeah, I was just gonna say that one of the questions that we should ask and we'll always be mindful of is how fast you need to close because even though the general overall estimate, I would say 30 to 45 days, there have been some cases where someone had to close within a week or 2 weeks or whatever the case is. And if we know that deadline is looming, we have lenders that can close quickly and can move fast. And so a good practice would be to find out exactly when the deal has to close. And also that leads to what Alan was talking about earlier with regards to risk and interest. You know, if you need to close quickly, they can't expect to pay a lower rate. They're going to pay a higher rate. And the LTV may not be as great, but we still can get some of these things done. So there are some situations that we've closed deals very fast. We can bypass sometimes the appraisal. It's not a common thing, but we can. But again, just to keep in mind, sometimes it's good to ask when that deadline is. And once we know about it, like Alan said, we move to push it as fast as we can. But it is a good practice to ask that question.
Yes. Thank you, George. So the next question is that has a lot to do with down payment, right? So they're purchasing a warehouse, office, retail, shopping mall, whatever that might be. What's the LTV? So LTV stands for loan to value. That has a lot to do with how much down payment that's required. So as I mentioned, if a purchase, the minimum that we require you to put down is anywhere between 30 to 40%. So the LTV would be somewhere around 60 to 70% for this type of product. Um, if you're refinance, okay, if you're refinance, that will depending on the rent roll, depending on the DSCR. Um, we've seen in cases we can push as high as 75%, but I think that is pretty much the ceiling for commercial products. Okay, so those are the questions that we have for commercial properties. Let's move on to working capital. So working capital is SBA loan, equipment loan, so on and so forth. Uh, First questions: what are the down payment for equipment? So for equipment loan, most of the time we can fund 100%. 100% of the equipment, assuming the client has the following conditions. They have been in business for over 2 years. They have their income can support that loan. So as long as they can meet those two requirements, most of the lender will be able to fund 100% of the equipment. Now, however, if the business it's less than 2 years, or if the client have challenging credit, so then in that case, we might have them to put down some sort of down payment, 10%, 20%, all the way up to 50%, depending on how big that loan is. But the most important thing for this type of loan is cash flow. Okay, cash flow of their business. Now, what type of equipment can be funded? Now, let's define equipment first. Okay, on our line of business, equipment defines that essential items is needed for this business to generate income, meaning that without this equipment, this business would not exist or cannot operate. Give you an example. A restaurant, you need to have a refrigerator. So that refrigerator is an equipment. All right. Mechanic shop, the jack. The jack is an equipment. Okay. Um, a spa, the massage chair, it's an equipment. All right. So those are the equipment. You got the idea. What is not equipment? So let's say for a restaurant, you need tables, chairs. That is not equipment. Okay. That fall into working capital. That does not fall into equipment. Because again, without chairs, you can still sell food, right? You think about this, right? A carry out place, there's no chairs, there's no tables, so on and so forth. So those are the equipment that we talked about. Hopefully you have an idea. Now, a photographer, that camera is an equipment. Okay, a graphic designer, that supercomputer, it's an equipment. All right. So this type of equipment can be funded. Anything else, you need tables, you need pencils, you need a computer, a personal computer. Those are not equipment. Those can be fall into the category of working capital. So working capital, you can use that money for purchasing items like this, purchasing inventory. That's the right word. Purchasing inventory, purchase or hire staff, or renovate the the facility, so on and so forth. Okay. Next thing is that can a newly formed company get funded? Now we are talking about working capital right now. Um, could be yes, could be no. So let's dive into it. When you are asking for working capital, now this type of loan, we are assuming there's no real estate associated with. There's no real estate attached to it. Okay. So when a company is asking for funding, the lender need to have some sort of collateral, right? We talk about a 5C. We need to what about the collateral. So in this case, the collateral is what? Is the cash flow of the company. So now if this company is a brand new company, which means that there's no cash flow, okay? So in that case, most lender would not fund what? Would not fund working capital. However, if a newly formed company are purchasing equipment, yes, in that case, then they will get funding because that equipment becomes what? Becomes the collateral for the lender. Okay. Also, let's say a client already running a bakery store. Now he set up a new company to open up a new bakery store. Can he get funding for it? Yes, in this case. It's just because he has the experience, he already have a bakery store, even though he set up a new company, but from the lender's perspective, that is an expansion of their business. They can use a different LLC to hold a different location. That's absolutely fine with that. So experience is very, very important. Now, if somebody's saying that, hey, I used to be an engineer working for Lockheed Martin, and now all of a sudden I retire, I want to open up a mechanic shop, most likely it's not going to work that way. And another situation is if the client get himself into franchise. Yes, in that case, the possibility for him to get funding is very high, even though it's a brand new company. Because franchise, they have it. If this is a SBA approved franchise, that means that they have good training program. So the lender does not worry about, you're not making money. So at the end of the day, the lender, what they wanted to see is, hey, how can you pay me back my $1 million that I lent to you? How can you guarantee me, right? So without any real estate, they're looking at experience. So experience is very, very important. So a newly formed company can it get funded? Yes or no? Now, however, if this property, not property, if this client it's purchasing a building, purchasing a building to open up a business, then yes, we can always fund him to purchase the building, but not the working capital if that client does not have any experience. So, for example, in today's market, we have a lot of foreigners coming into the United States to set up factories, to set up business, because they're already doing very good in their own country and now they want to expand into the United States. Absolutely fine. But because they do not have any history or any record to show that they have that kind of experience, we can only fund them to purchase the real estate. We cannot help them we cannot give them funding to working capital, for example, to fund the business. Okay. So that it's these questions. What is the rate and term? What are the rate and terms for working capital? There are many different type of working capital. So let's dive into it. Working capital. The first one, it's pretty straightforward. It's SBA loan. We've done a lot of SBA loan. So um, SBA loan use what? The interest rate on SBA loan. Also remember, it's prime rate plus a margin. Prime rate in today's prime rate is what? 6.75% plus a margin. The margin normally is 2% to 3%, somewhere in between. The if the deal is better deal, might be 2%. If the deal is not a good deal, there might be 3%. So again, anything in between. So if 6.75 plus 2, you're talking about 7.75. Plus 3, now you're talking about 9.75. Okay. So the good thing about SBA loan is that when the prime rate drops, then the interest rate will drop. So we are at a very high prime rate right now. Last year at this time, I think we're at 8. Is ridiculous at 8%. But luckily now we are at 6.75. Okay. And they are saying that, hey, we might get a lower rate this year. So let's see. Now that's SBA loan. Now SBA loan, the term normally is 10 years for uh, no real estate attached to it, just purely working capital. 10 years. If there's real estate attached to it, will be 25 years. Okay, so that is SBA loan, rate and term. Now, we also have other type of equipment loans, for example, equipment loan. Now, equipment loan, it doesn't really have what they call interest rate. We don't call it interest rate. We call it buy up rate. What does it mean? Buy up rate means that, hey, I give you $1. Let's say the buy up rate is 1.3, for example. Means that I give you $1, you pay me back $1.30 in a particular time frame. Let's say in 20 months, 24 months, 60 months, whatever that might be. So see this type of loans like a car loan. Okay. You go buy a car and they would tell you, hey, your monthly payment is $300, $600, right? So that is what they tell you. What that equipment cost you is. So same thing with equipment loan, that's what they tell you. With this equipment, $400,000 equipment, and your monthly payment is $1,500, $2,500, whatever that might be. Okay. So that it's the rate and term for working capital. The next category is the real estate investment. This is regarding to 1 to 4 unit portfolio loans, mixed use, multifamily, so on and so forth. How to qualify DSCR loan? So let's define what DSCR, debt service coverage ratio. So please remember this acronym. Please understand what this means, right? Debt service coverage ratio. So basically means that can the income of the building, of the property, covers the debt of that loan. So give you an example. Let's say you have a rental property that you are generating $1,500 a month. So that $1,500 is your income. Now, what will this $1,500 cover? It covers what? It covers your tax, property tax. It covers your insurance, property insurance, right? It covers your what? Mortgage. Okay. So those are the three main big items that this $1,500 need to cover. Now, of course, you will have repair, maintenance, things like this. But that type of expense normally the lender would neglect because it's not an occurring expenses. So as long as the $1,500 can cover these three items right here, mortgage, property tax, and property insurance, then this property it can be debt service. That's what we mean. What are we looking for? What does the lender look for? The lender normally look for a DSCR of what? 1. Okay, DSCR of 1, meaning that your income and your expense, your income divided by your expense equals to 1, meaning that you don't lose money, you don't make money, the debt, the income covers the debt. The income service the debt. Okay, so that's what it means. So how to qualify for DSCR loan? So we need to look into what? Your property tax, your property insurance, and your personal not personal income, the property rental income. Right, those are the three main number that we look at. And of course, we also need to look at the credit score. Credit score need to be what? When you do a DSCR loan, we want to see your credit score minimum at 660. Oftentimes we look at that scenario come in and we see the credit score is like 600, 605, 610. Most likely you're not going to get a DSCR loan. Okay. So those are the four numbers. And what is the last number? The value of the property. The S is value of the property. Okay. So those are the five numbers that we look at to calculate the DSCR and hence can tell you what that if that property can qualify for DSCR loan. So that's DSCR. Blanket loan, yes. Client is asking, hey, I have 5, 10, 15 properties, 10, 15 different loans. Can you combine all of them into one blanket loan? Yes, we can definitely do that. Okay, we can definitely do that. Um, it has good side and it also has bad side. The good side is that obviously we can combine all 15 property into one loan. Now, why do we have to do that? It's because when you out there to purchase uh property and each property got its own loan, now you have so many different loans that you didn't manage. Okay. Um, Especially for investors that they are getting their loans through a traditional mortgage company. Get to a certain point, the traditional mortgage company would not be able to give them a loan anymore. It's just because there's so many what they call DTI, debt to income ratio. There's so many loans. So by putting them into a blanket loan, and especially putting into a blanket loan under an LLC, using the LLC to hold on all those properties, it relieves the client's the liability from the client, meaning that when you check his credit report, you do not see that loan on his credit report because that loan is to the loan is to whom? To the LLC, not to that person. That is same thing. That is the truth for any other commercial loans that we talked about. Okay, so when you pull a client's credit score, as long as the loan is under an LLC, it would not show up on his credit report. So it free up a lot of his credit. Okay. And of course, much easier to manage if you have a blanket loan. Um, but however, what is the best side of it? The best side of it is that now you tie all 5, 10, 15 property into one loan. So in the future, let's say if you want to sell one property, then they have to do something called a partial release. So a partial release works like this. So assuming that you just have 5 properties, okay, easier for me to do the calculation. You have 5 properties, and each property is 200,000. Okay, so now you have $1 million loan covers that 5 properties. So when you decided to, sometimes down the road, when you decided to sell one property, now you have to pay back not the $200,000, but you have to pay back 120% of that loan. So now instead of paying back $200,000, then you have to pay back 200 and what? $240,000. So now basically by the time that you pay down the fourth, the fifth one, you're already free and clear. Put it this way. Okay, so that's how blanket loan is set up. Okay. So can we do it? Absolutely, we can do it. But however, many lenders right now, they will see a blanket loan as multifamily. In reality, that is true because you have one loan that you covers many, many different properties. It could be multifamily. Once you get up to 4 or 5 units, that becomes multifamily. And multifamily's rate, it's higher than 1 to 4 units. So in some cases, we will suggest our client if there's not too many uh properties, let's say if you like 5 or 6 different properties, I would rather them to have 5 or 6 different loans, even though it's a little bit more complicated um to manage. But again, the interest rate will be much more favorable to the client than if you would do a blanket loan and of more flexible too. Because again, in the future, if you want to just refinance one or you want to sell one, it's very flexible instead of tying everything into one blanket loan. But of course, we can definitely do that. And for blanket loan, we can also tie in some lenders, we can also tie in commercial property and residential property together. It's called what they call cross collateral. So there's a lot of things that we can do um, on the commercial side. Next question, how to fund mixed use? Mixed use, what is mixed use? Like what it says, mixed use, commercial, most mixed use works like this. You have the commercial in the at the bottom, and then you have residential on top. So that is what mixed use is. You have two use purpose. The bottom floor is a retail, it's a shopping, it's an office, upstairs are residential. So that's mixed use. So mixed use, normally what we like to see is the square footage of the residential component versus the commercial square footage of the commercial component. Now, if if the residential is the majority, when I say majority means that 75%. Let's say the entire building is it's let's say 10,000 square feet, okay? Yeah, for an example. And let's say all the residential unit, it's about, let's say 75%, 80%, it's residential. There's only 20% of commercial. So in that case, we might be able to fund this mixed use as a multifamily, which means that the rate would be lower because from the lender's eyes, majority of the income is from the residential instead of the commercial. Okay. So that might be a possibility. And that is why when you go to our scenario form, um, we ask you what is the square footage of the residential and what is the square footage of the commercial. And that's the reason behind it. Right. So we might be able to structure the deal as a multifamily instead of a mixed use. But of course, if the commercial and the residential are equal or even more, then it has to go into a commercial loan. So for something like this, we do need to see the rent roll. We want to see, who's living there, how long, what is the lease for each unit, what is the income from each unit, so on and so forth. So that is how we structure a mixed use. But mixed use, it's pretty straightforward. Um, you know, it's pretty straightforward. That's mixed use. Multifamily, very similar to mixed use. Multifamily, it's 5 unit and above. Okay, 5 unit and above. Now, with multifamily, if the multifamily is stabilized, they're getting market rent, and they are over 80% occupancy rate, that building will get the best rate and term and LTV. So for something like this, we can definitely go with a Fannie Mae, Fannie Mac loan, can go all the way up to 80% LTV. And interest rate, I believe I need to check. Okay, so last week when I checked, the best interest rate that I've ever seen is about 6%. But that's last week. I don't know about this week. I got to be a little bit higher. So that it's multifamily. But of course, we also need to look at the occupancy rate. If the occupancy rate is less than 75%, then they will consider that is not a stabilized property. Or if some of the multifamily are in a rent control zone, for example, in California, in Bay Area, so on and so forth. So even though the value of the property is very high, but a lot of those tenants have been living in that property for the last 10, 20 years, and they are still paying $1,000, $1,500, whatever that might be for the rent, even though the market rent is already at 2,000, 3,000. So again, we're seeing a lot of multifamily in California, or especially in the Bay Area. It just cannot get it done. It's just because the rent is very low, even though the value of the property is high. Okay, so that is something that we need to pay attention to. Same thing with New York. I think in New York there are a few areas that is rent control. So don't be surprised. A lot of people come to us saying, "Hey, how come my property worth about $2 million and you can only give me 30%?" It's just because the rent is it's not there. However, if you're looking for a short-term loan, then we can give you more money that will base on the value of the property instead of the income of the property. But short bridge loan, as we all know, it's a short-term note, 24 months, maximum 36 months. Then you have to figure out how to get out. Okay, but multifamily, it definitely is one of the good asset out there. A lot of lender love multifamilies. Documents, and also asking for what document do you need? For this type of loans, we do not look at their personal income. Okay. We only look at rent roll. Rent roll means, we have a form for you to fill out. Each unit, if we're talking about multifamily, mixed use, each unit, who's living there, what is the lease, when the lease start, when the lease end, what is the monthly payment. If this is a commercial mixed use side, mixed use, we want to see who's paying for the insurance. Is that a triple net lease, so on and so forth. So the first document that we need is the rent roll. The second document that we need is what we call the operating statement. How much you pay for insurance, for property tax, maintenance, common area, so on and so forth. So with those two pieces of documentations, then we can calculate a DSCR. And of course, most of these property we want them to be under an LLC, especially mixed use and multifamily. Now, single family home, you can get around with it. You might be able, we can still put it under a personal name, but we don't recommend it. We want them to be on the LLC, right? So in that case, we want to see the LLC name and not LLC documentations. We want to see the operating agreement, who is in that LLC, who's, how many partners, so on and so forth. We want to see an EIN. So basically, those are the few things that we want to see. And of course, the client's IDs. If this is a refinance, we want to see their rent roll. We want to see their rental lease. If this is a purchase, we want to see where their down payment is, so on and so forth. So the documentation is very minimal. Okay. Of course, other documentation we need is appraisals, insurance, titles, but those are third-party appraisal, third-party documentations. So those are the set of questions that people ask often, and I want to share with everybody what they are, and hopefully you know how to answer to your answer to your client if your client's asking you, or even you have such a questions and now you have the answer. Okay. So here I'm done with my presentation on this particular topic. So let's open up the ground, let's open up the floor to see any other questions that might be able to answer. Or George, if you want, George, again, if you don't know George is our VP of origination, and a lot of the deals that he is the one that is actually working in the back end with Becky and his team to get everybody to go to closing. So George, if anything that you need to you want to add, please feel free. Or anybody have any questions, feel free to jump in, unmute yourself.
Mr. Allen, thanks a lot. That was very informative. Just had a couple of things. On the bank side, we go back to what we talked about, banks turning down deals. A lot of times it's not just the credit, it's the asset type and also the experience. So keep in mind that we can also do inexperienced borrowers, like we're doing a deal in Texas where there's an individual who's picking up a multifamily property and putting in around 800K or so worth of work, and there's a lender that's willing to fund her. And so experience plays a part. Banks will not lend to someone like that, whereas we can find solutions for that. So again, keep in mind that it's not just the credit or different things that banks look for. It's also experience, and also we find solutions. And so banks also, like Alan mentioned, are very slow. We can get it done quickly. So again, just keep that in mind as you talk to these borrowers and the scenarios coming to you guys.
Yep. Anyone else? Comments, questions, or tell me what you want to hear? Because again, we can talk about this type of stuff. Oh, by the way, from now on, we're going to have finally we're going to have our read channel. It's a real channel, meaning that hey, we are going to record some on a daily basis. We are going to post some information about commercial funding onto Facebook, onto Reel, onto YouTube, so on and so forth, so that hopefully we can provide some valuable information on the daily basis. So keep that in mind. If nothing, then we call it a night. Okay, guys. Well, if that's the case, well, thank you so much. And I see you guys next Wednesday. Good night, everyone.
No, thanks a lot, Al.
Yep. Thank you.